Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Seema Shah, Chief Global Strategist, Principal Asset Management. Seema, nice to see you.
Great to see you.
So, I want to start off by asking you a little bit about themes that you think will resonate with investors in 2023, the balance of the year, and going into 2024.
So 2023 is going to be, I think, a fairly uneventful year until you get to late Q4. Right, so this is a little bit of the same. You have a very gentle earnings slowdown. You have the labor market looking pretty strong. And this is, again, in the context of a recession that everyone's been talking about for quarters and quarters and quarters. So we're really waiting to see the labor market deteriorate. But actually, if you look around you, things look fairly robust, right? Consumers strong. Labor market, of course, is very strong. So until you see that turn, which we don't think is going to come until later in 2023, things are going to still feel pretty good. But that's when the change comes, right? So when you get to late 23, things get a bit tougher. And then 2024, unfortunately, in some ways, at least from an economic perspective, looks fairly tough. But remember, as soon as you hit that downturn, that's when investors start to get excited because you know it's come and you can start to look to the other side because we are expecting this to be a fairly moderate downturn. So actually the investment opportunities for next year should be fairly strong.
Now, it sounds like you're kind of talking about a soft landing. Can I characterize it thusly?
Well, okay, so there's so many definitions of a soft landing, right? So the way that I'm thinking about it is we are expecting recession to hit the US economy late in 2023, but this is a very standard, modest recession. So 3/4, the average length of a US recession, and nowhere near as deep as, very severe downturns that we've seen in the past. So it doesn't leave any permanent damage to the US economy. It's something that you can rebound from pretty quickly because, again, this is a normal, traditional business cycle, one which is created by a Federal Reserve, but also destroyed by a Federal Reserve. But it's something they can fairly quickly bounce back from.
Now, are you one of these people, Seema, who keeps pushing out the recession quarter after quarter after quarter? Have you been doing that?
So you're right. There's so many, you have seen so much of this. We keep pushing out the date. No, we've had a fairly consistent view that the second half of 2023 is when you start to feel the effects. The thing that we have seen is, of course, is the banking crisis, which has maybe brought it a couple of months forward from what we were talking about maybe at the beginning of the year. But this is a fairly consistent conversation that we've been having.
And you've been talking about decreasing exposure to equities and also singing the praises, perhaps, of commodities and real assets. Doing that going back to last year. Is that right?
That's right. So we have been fairly underweight equities in this expectation that 2023 is when you start to think about growth, start to really feel a bit of an earnings slowdown. The commodities part is really interesting because we have really believed in real assets. We continue to believe in real assets because we think that investors are underestimating the persistence of inflation. Right? We can see that there's disinflation. It doesn't mean that it's disappearing entirely. The commodities part is actually very interesting because although that's a traditional real asset, this year, because you've got a bit of a push and pull, so you've got the China growth story on one side, but then you've got a US slowdown on the other side. So as long as those are putting in different directions, actually, this is, for us, it's a time to be neutral commodities. We're very positive on the longer term because there's been a real lack of investment into this space. But at least in the next 6 to 12 months, we're pretty neutral on commodities for now.
So, but other hard assets are attractive then?
Yeah, so one area that we do like within at least the real asset space is listed infrastructure, right? So it's not the hard assets, but listed infrastructure typically does very well when it's low growth, high inflation, and we've already seen that play out. It typically does really well when it's volatile times. So if you think back to the crisis with SVB, that is really when listed infrastructure came into its own. It really outperformed. The other parts of the space is actually, if you think about natural resources, hedge funds even. So when there's macro volatility, hedge funds typically do well. So this is a bit of the alternative space, which we're still fairly positive on.
And Seema, how do you think about global markets? What's your asset allocation model tell you there?
Okay, so this has been, I think, the more interesting part of the story for 2023. So if you think back to 22, it was all about the US, right? In Europe, you had the issues with, of course, the Russia-Ukraine war and gas prices. In China and East Asia, you had the issues with lockdown. You get into 23, and actually the narrative has changed completely. So Europe has managed to fare pretty well with gas prices fading off. You've had with China's reopening. And yet, on the other hand, you have the US coming into a slowdown. So you've had a complete reversal of the story. So actually, when we look at the global opportunity set, we now prefer the global perspective. So this is a story about emerging markets, really driven by China, looking for that opportunity to come back. Whereas for the US, it becomes less and less attractive as you get through towards the end of the year.
Really? So does that, am I hearing you right that you're sanguine about China?
We are fairly sanguine. We're also not very, very bullish, right? So the China story is going to be an interesting one. We have an issue where people have always expected, looking at the reopening stories from the US and for Europe, they came into 2023 expecting China to have a wonderful boom. You had a huge amount of pent-up demand, firing up growth and consumer spending. Well, that didn't happen. And the reason is that the China's consumer is still pretty cautious. They've gone through 2 years of rolling lockdowns. That caution doesn't just disappear. At the same time, China's savings rate has been structurally increasing for many years. That's not yet going into reverse. And the third thing, which is I think is the most important, is that behind closed doors, I think you've seen that the government has started to take a different approach. They're not moving towards counter-cyclical policies where you have a huge boom, a huge bust. They're now looking at quality of growth, not just quantity growth, but quality of growth. And this means less impact, less focus on leverage, right? Less focus on easy monetary stimulus. But it does mean that you're looking at more modest growth over the long term. The interesting is look, investors might be a little bit disappointed, right? They've been accustomed to 8% growth, maybe disappointed you're not going to see that again. But when you have stability of growth, actually from a longer term perspective for investors, this is a lot more important.
Just one more question about China, Seema, and that is, and I'm sure you've seen these numbers talking about China's population decreasing significantly. Isn't that going to be a huge problem for this country over the next decade or so?
I don't think so. You can almost say that actually when your population is increasing at such a quick pace, it can become even more of a problem. So I think that actually we were looking at a slightly different perspective. And the thing is also, this is still a very, very enormous economy, a huge population. This is a strategically focused economy, which is thinking about the future and also planning for the future. It's not an economy which is blind to the idea that population is going to be decreasing. So actually, no, that is not a concern.
Shifting back to the United States, how do you assess Jay Powell's regime and his program of addressing the economy?
So they made a huge mistake at the beginning, right? They looked through inflation, they assumed that it would disappear. They, I think, like many investors, had become accustomed to this low inflation environment and believed it would persist forever. And of course, that was incorrect. They've been playing catch up. They've done a pretty good case of playing catch up. They now have to really think about financial stability, of course, but it doesn't mean that price stability has to fall off. So I think it's something that they have to keep an eye on. It's one of the reasons why we are not expecting a cut in interest rates anytime in 2023. And in 2024, we're also not expecting rates to come all the way back down to zero. In fact, we're looking at a future where you have around 2 to 3% inflation. It's a very different environment to what we've had over the last 10 years.
So wait a minute, they'll actually be hitting the target? I mean, the inflation target is going to hit 2 or 3%, and how would that happen? So there's enough sort of persistent inflation in the global economy?
So there's a couple of things, right? So on the cyclical side, there is going to be a recession which helps bring inflation down towards that 2% level. But then you've got to think about the structural factors, which are going to start to play in more and more as you look forward. So one thing is going to be deglobalization. We know that that's already underway. You're seeing the continuation of reshoring. That's the key thing. You've also seen this Pandora's box of fiscal policy be opened. Okay, so governments around the Western world, in the US included, have become really accustomed to using fiscal policy now. They know how impactful it could be. So we are expecting a return of that, which unfortunately does tend to be inflationary. Actually, you could say in the negative or it could be in the positive. But we are looking at a decade of inflation averaging around 2 to 3%, which is about a full percentage point higher than you've had over the previous decade. That might seem small, but from an investment perspective, it's pretty important.
Well, what does that mean for investors then?
Well, okay, so one thing is that when you don't have 0% interest rates, so you don't have those easy financial conditions, investors have to be a lot more discerning, a lot more selective. If you think about just about the banking crisis that we've had this year, one of the things is that having higher interest rates has revealed a lot of vulnerabilities, a lot of problems that companies have maybe hidden behind the scenes over the past decade. You've had low interest rates. So for investors now, with rates being a lot higher over the outlook, they have to be a lot more careful. Think about what is a balance sheet, what is the stability, what is the leverage. So that is a more discerning investor that's required. There's also potential of return to value. Now we've had a 10 years of growth really, really outperforming. But in a higher inflation environment where rates are permanently higher, actually that could be a better environment for value. And interestingly, that also could play into Europe's potential. Now, Europe cyclically maybe isn't particularly strong, but if you're looking at it over a structural perspective, and you're thinking about value growth, this could be a decade for Europe to perform again.
Sitting in London, you say, although no longer part of Europe.
No, unfortunately, no longer part of Europe.
Yeah, so tell us about what's going on in Britain right now, and how is the economy faring in the post-Brexit era?
So I think the one key thing that's happened post Brexit is that you have had a flood out of labor, right? So a lot of people have left the United Kingdom, and just similar to what you have in the US, but something could maybe be reversed. You have an incredibly tight labor market. So when you're thinking about the United Kingdom and you're looking out over not just the next year, but actually like the next 5-10 years, unless they're able to attract significant pool of labor back into the UK economy, you are looking at a permanently higher inflation rate, a tighter labor market, higher wage growth, and unfortunately a less productive economy.
You're hearing a lot of talk about private markets. Maybe some people even saying the alpha has been taken out of public markets. Private markets are something that regular investors need to know more about. What do you think about that?
Oh, absolutely. Okay, look, public markets have performed worse than private markets so far. So now we are expecting, I think, along with a lot of people, that private markets are due for a catch up. So maybe there could be a bit of a correction in the next 12 months. But if you're looking out over the next 5-10 year period, where are you going to get returns from? The next 10 years is a period of high volatility, lower returns. So you have to think, again, selectively, but you have to be a little bit more exotic in your thinking. So a perfect place for that is private assets. We do believe that the significant returns are going to come from that space. So if you're thinking in a broad asset allocation portfolio, you need diversification, of course, within public markets, but private markets is going to be very, very key for any investor who wants to reach their return potential.
I know you're a bit of a data geek, Seema. What sort of analytics and tools do you find that are most useful in the kind of work that you do?
So you're right. So look, you can't do any investing these days without having some kind of focused quantitative models. So we have a huge suite of quantitative models that we pursue consistently and continuously adding to that suite as well, so we can have a better understanding of the economy. Again, you can't have a conversation without AI. That, of course, has to be intrinsic to any kind of portfolio management. So we try and make use of it. But remember, as well as having quantitative analysis, it's still really important to have qualitative, to have a better understanding, to understand the central bank, understand the communication, credibility issues, which is something that actually quantitative portfolio analysis can't always capture.
And that leads to my next question then, which is what sort of temperament do you think is best suited to become an investment professional? Have you ever given any thought to that?
Yeah, so someone who's analytical, I mean, it has to be absolutely key, but also someone who doesn't get caught up in the emotions. You know, you wake up in the financial markets and you see a headline and it's a little bit concerning. You can get a little bit crazy, make decisions which you shouldn't do. So you have to be someone who can take a bit of a balanced approach, give yourself time to learn, know the history, right? Understanding economic history and financial history has got to be key. When we do any of our analysis, we're always looking at how history is performed. It gives us a guide to the future. And that, I think, is a really important part of anyone who's entering this market.
And final question, Seema, what advice would you give to aspiring economists or investment professionals to help them in their careers?
Read. I think it's important for any kind of career. But the one thing is you've got to read everything you can. Read the financial news, read economic news, but read normal news as well, because so much now is about psychology. How is investor behavior happening? How is it going to be impacting things? So just reading a copious amount, I think, has got to be the number one part of any skill set that somebody who wants to enter the industry is.
All right, Seema Shah, Chief Global Strategist, Principal Asset Management. Thank you so much for your time.
Thank you so much.